Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and I have with me here this morning Graham Witcomb, who's back from holiday, back in Canada with a new PM. How's that going, Graham?
Yeah, day one seems to be a success. So
Really? He got up?
We haven't been invaded by our southern neighbour.
Yeah, I was going to ask, Vancouver's still there, right?
Vancouver's still there. That's right. And Gaurav Sodhi, and we are all gathered here today to talk about hot retail. The reason why we're talking about retail is because it's a fascinating subject, and we do have some very interesting stocks to talk about today. But I think we'll kick things off with Graham, who covers what we might call the boring side of retail. Let's start there, Graham. Can you talk about the supermarkets and how they're different from what most people think retail is compared to the specialty retailers we're about to talk about?
Well, I mean, for me, when I think of retail, Woolworths and Coles and other the big kind of staple retailers are the retailers I'm thinking about, because they're definitely the largest in terms of sales compared to any smaller retailer. And I think they kind of capture the typical retail business model pretty well, where it's a hyper-competitive space. You're dealing with other companies that pretty much are selling all the same products, and so you're left just kind of struggling with price controls and that sort of thing, or discounting. And the main benefit you get is from scale. The bigger you are, the more you can spread your fixed costs across the same number of items, and then be able to kind of fight more aggressively on those price discounts. And Coles and Woolworths have done that pretty well. They're two of the most profitable consumer staple retailers in the world. And I mean, part of that's because of the oligopoly. But the other part is that they are just quite effective businesses, and they do pretty decent returns on capital. And even though they have these very thin margins of just a few percent as a profit margin, they're able to turn that into pretty decent returns for shareholders over time.
And we do have one of those on the buy list at the moment, which is an interesting story. It's kind of a bit of a turnaround story, I suppose. But Aldi is, how do you say it? Is it Aldi or Aldi? It's Aldi, right?
I say Aldi.
Do you?
I've never even heard Aldi. Who says that?
I don't know. Maybe it's just mine.
It's just
the circles you walk in, John.
That's right.
Le Aldi.
Pasta. Now, so with Aldi, it's been around for 15 or 20 years. What impact would you say it's had on the two major retailers?
I think it has had an impact. It's probably meant that they have to lift their game quite a bit more with their discounting, but I don't think it fully overlaps the customers they're going after. Aldi has a different business model to Coles and Woolworths, which are much more just the kind of big shop mentality. There's also, I think Woolworths and Coles had quite an advantage to start with, in that a lot of retailing for groceries is based around the property portfolio. Right. That it's not just about who's discounting or what product you have on the shelf, but how far are you from the population you're trying to serve. And I mean, Coles and Woolies have been around for decades. They had all of the best spots in Australia. And so Aldi has been mainly having to take the new developments and maybe poach a few stores here or there that are in the more established areas. So yeah, Coles and Woolies were working from a position of strength, but Aldi has come along, and it has the other two's margins have come down over time slightly. So I think that, at least in part, is probably attributable to a strong third competitor.
I do think that one thing that Aldi has done to the benefit of Coles and Woolies is it's normalized the purchase of home brands. We're all old enough here, gents, to remember that when we were younger and we went to supermarkets, buying home brands was considered something of a step down, and it was frowned upon, and it was kind of embarrassing to buy home brands, right?
That was Franklin's, though. That was a black and gold thing, which were truly terrible products. Yeah. I think that was largely Franklin's that ruined that idea in the minds of the consumer.
But home brands, even from Woolies and Coles, were discount cheap items that were aimed at consumers who wanted to spend less. I think what Aldi has done is normalized the purchase of home brands, and Woolies and Coles both now have home brands at every price point. You can buy a Coles premium product, which is sometimes more expensive than the branded stuff, and that was, I think, unexpected pre-Aldi, and I think Aldi has helped to make that possible.
Yeah, and they've done that by, the Aldi strategy is fascinating from a marketing point of view because they basically rip off brands like established highbrow brands.
Shamelessly
with their packaging. I don't know how they get away with it, really.
Yeah.
But they seem to just do it and it works for them. But I think you might be right about that. I still buy Legina crushed tomatoes. I just think they're way better than any other tomatoes that's my tip for the week. Legina crushed tomatoes in a tin. Wouldn't buy the home brand stuff, especially the stuff that adds basil. But I think you're right. There was a big opportunity there for the supermarkets 10 years or so ago to start doing their home brands, and they just seem to be getting better and better at it.
Yep. The UK supermarkets, which is a really competitive space, they also have been going along that same path, and I think it's not a coincidence that Aldi and Lidl are two thorns in the sides of those UK supermarkets. And that seems to be playing out here as well.
It is an interesting case where it seems to be a global phenomenon. All of the big retailers over here in Canada or North America have got the same strategy of having their own brands now. And it's kind of weird that the world just suddenly woke up, say 20 years ago, to this opportunity that, they could have done it decades earlier, and yet it just seemed to catch on 20 years ago or 10 years ago. I wonder why that there was just a sudden shift in people's mentality, or maybe in the branding itself.
I think it's if you control distribution, which the big supermarkets basically do, then you have all sorts of opportunities to go up and down the value chain.
Absolutely.
I agree with that, but they controlled distribution long before 20 years ago.
That's true. That is true, yeah.
So why now?
Well, there's that's not the only change. If you listen to what Woolies is saying and kind of look at their product portfolio, they're expanding into insurance product, mobile phone products, even energy, and they've been trying to get into the pharmaceutical game for a long time. I think the real core, one of the core competitive advantages of these two supermarkets is the ability is logistics. It's the ability to move lots and lots of products quickly around a large store network. And they kind of remind me of iron ore miners in a way, because everyone thinks iron ore is a business about digging up stuff out of the dirt, but it's actually a business about moving low value material around vast quantities of ground at the lowest possible price. And that's exactly what supermarkets do. They move really low margin stuff as efficiently as possible, and that's the source of their advantage, and that's what keeps
that's quite an interesting
competition away.
Take on it.
Well, there's not too many iron ore analysts looking at supermarkets. That would be my guess.
Graham, one question for you before we take a quick break and discuss the hotter side of retail. We've had this ACCC inquiry or some kind of government inquiry into the supermarket duopoly. Is that out yet? I think it is, isn't it?
Yeah.
What were the conclusions, and is regulation a threat to the two big supermarkets? Because I find it hard to imagine how you could break these businesses up, how you could regulate them in a way that would stop them from doing what they're currently doing. I just don't see how that would happen.
Yeah, I agree with you. I think that the report came out and it kind of told everyone what everyone already knew, which was that these are two powerful companies in an oligopoly and there's little incentive for them to compete too hard against each other. But I think the government's in a tricky position because you can't, unless they step in and start doing all kinds of crazy stuff like regulating pricing or something like that, then I don't see how breaking them up wouldn't hurt the consumers they're trying to help.
Right.
So, the big benefit of having this oligopoly in place is that there really are economies of scale to running a supermarket chain that covers the whole country or that is as large as they are. And those, because if they're only earning a few % margin, that means that all of those cost savings are being passed on mostly to the customers. And so breaking them up, I think, would inevitably add costs, and that cost would be passed on to the customers. So I don't see how the government can really win by that.
I remember a time in my life where I too used to think that governments couldn't do crazy, stupid stuff.
Oh yeah.
Well, but now I've learned.
Yeah, I should say I don't see how they could rationally.
There you go.
No, right.
It's also to say that the voters won't ask them to, so without understanding all of the these details about economies of scale. Yeah. So
I think if you're going to do forced divestitures, I wouldn't start with supermarkets. I'd start with airlines and force Qantas to
I agree.
separate from Jetstar. But that's off the table because all the MPs enjoy their time in the chairman's lounge. So I don't think that's going to happen. Okay.
Yeah. And I think supermarkets are also, I think, a little bit insulated in that they are, if they were to be split up, it would lead to price inflation of groceries, and nothing hurts voters more than grocery prices going up. So I think the government would be pretty cautious about doing anything to shake it up. It's great to bang their chest and say that the supermarkets are the bad guy, but I don't think they're going to do much to actually break them up.
But John, I don't think that's the breakup is not the major threat here, and it's probably not even the major aim. I think what's really hurting is, when there's general inflation, supermarket profits generally hold up well because they earn a percentage margin, and in inflationary times, that translates into a higher dollar margin. And I think all this attention stops supermarkets from capturing that dollar margin, and it stops them from raising prices the way they have done in the past, and they have to wear the inflationary pain.
Well, it didn't stop them doing that during COVID. I think
during COVID. We didn't have this kind of pressure during COVID. I think the aim of all this pressure is to make sure that doesn't happen again. I mean, look at the trajectory of margins here. Supermarket margins have fallen a long way. There was a time where Woolies was the highest margin supermarket in the world and is now merely average. So to some extent, the pressure has kind of already worked.
Yeah. I think from an investment point of view, like we're talking about two very defensive companies and the risks are minimal to these businesses. I think the regulatory threat is almost zero. And even Aldi, maybe the government could come in and sort of force the big supermarkets to sell some of their sites that they haven't yet developed to Aldi, but even that seems like a very low probability risk. So to me, these seems like really good defensive companies. If you're looking for a decent return rather than a remarkable return, it's a nice, safe place to put your money. Graham, would you agree with that?
Yeah, they are. They're not going to shoot the lights out. They're not the best deals that we can find on our buy list, but for someone who's looking for a steady, decent return with a decent yield and pretty stable growth prospects, then they're a good core holding to have with pretty low risk, I think.
Okay, we're going to take a quick break and we'll be back in a few minutes just to talk about two far more exciting companies.
Want to take control of your financial future and sharpen your investing skills? InvestSmart's Bootcamp for Beginners is the perfect place to start. This flexible online course covers everything from the basics of investing to creating lasting wealth and building better money habits. Access on-demand videos for 3 months and learn at your own pace whenever it's convenient for you. Usually $99, Stocktake listeners can save $50 with the code MONEY50. Head to investsmart.com.au/bootcamp and use MONEY50 to save big today.
Okay, and we're back, and we're going to kick things off with a discussion about two specialty retailers. We have to say, I think we should disclose that our recommendations history in this area has not been great over the past 25 years. I remember being scarred by a company called Miller's Retail, which looked like a great business, but it slowly turned into a poor one, and we got stuck with that business. It's a really, really competitive area, and it's very rare for retail concepts to be highly successful, highly profitable, and go through a big rollout before the competition catches up and squeezes margins and make them look very average. What makes JB Hi-Fi different to that, do you think, Gaurav?
The reason why it's so difficult to maintain leadership in traditional retail, in specialty retail, I should say, is because the concept is so easy to copy. Retail is really just gathering items and selling them on at a higher margin. And if you don't own the original goods, it's a business model that can be easily replicated. So you've got to find a way of protecting your business. And there are a couple of ways to do that. The way JB does it is simply by having the lowest costs, and that is the hallmark of that business. JB is arguably the lowest cost retailer in the world, and we measure that by something called the cost of doing business, which is all the non-product costs associated with JB, and comparing that to the revenue. Can you
explain that in more detail? What does the cost?
So the cost of doing business is all their non-product costs. So we're talking about things like wages, corporate, rent,
distribution costs,
and distribution costs. Correct. Yes. So that's
advertising costs.
All of that. We bundle that up together and compare that to a percentage of sales. So I covered this recently in an article, which is available on our website. And JB is roughly about 14% of sales. All those other costs associated with retail is about 14% of sales. And just for comparison, the global benchmark is Best Buy, which is the JB equivalent in the US. That's often considered to be the best electronics retailer in the world, and they're at 18% of sales. And a typical specialty retailer, someone like Kathmandu, 50% of sales. Somewhere between 30 and 50% is typical for a retailer. 14% is unheard of. And I have seen JB get as low as 11% of sales.
So why is that? How do they manage to do that when they're lugging fridges around the country rather than, mini jumpers for $400?
Yeah. So they're famously tight with costs. Low costs have been built into the business model from scratch, from the very first store that opened. But in more recent times, the way they've garnered their benefit is by bringing customers into the mall. So they are able to get sweetheart deals with landlords who like to have a JB Hi-Fi as an anchor tenant because it brings in customers, and they can charge higher rents to smaller retailers. So in effect, the competition is actually subsidizing the rent of JB Hi-Fi because so many people come through those doors, and it attracts so much thoroughfare.
It's an important concept to understand for investors, I think, because rent is a horrible obligation for a retailer. It's a contractual obligation, so you can't just cut your rent unless you're really big and the shopping centre doesn't really have a choice. So having that pull, and you call that an anchor tenant, so a kind of business that draws a lot of people in, and that used to be department stores. It used to be Myer.
Correct.
And they've sort of declined in importance, but JB Hi-Fi is taking their place and is basically getting sweetheart deals as a result, and that lowers their cost of doing business.
There's also
a high component to it.
There's also a lot of discipline in the pricing strategy at JB. So this is one of the best quality retailers in Australia, if not in the world, and it generates net margins of sort of 4% or so. Now, most of the time, investors will look at a 4% margin and think of that as a sign of weakness. It is actually JB Hi-Fi's greatest strength, because it makes competition more difficult, because who's going to try and replicate JB in terms of distribution, in terms of site selection and scale, all for a measly sub 4% margin. It's very difficult. Yet that small margin, because of the vast asset turnover, the inventory turnover. So JB will turn over its inventory 5, 6, 7 times a year. That results in returns on capital of about 30% or so, which is exceptional. Yeah. And they've been able to maintain that return on capital for decades.
Yeah. I've had people in stores come up to me when I'm checking prices on my phone and say, whatever price you're looking at, mate, we'll beat it. We'll match it.
Yeah, that's a policy of JB. So that was brought in to fight Amazon. So if you want a better deal at a JB, just walk around and look at your phone. Someone will come up to you and say, whatever Amazon is doing, we'll beat it. And they will. Another differentiator is the service model as well. I think one of the big reasons why everyone loves shopping at JB rather than a Harvey Norman is because Harvey Norman is heavily commission-based, and it's a high because Harvey Norman is heavily commission based, and it's a high pressure environment because the sales staff really need to earn their commissions. Whereas JB is not like that. There are incentives for staff, but they are not wholly commission staff, and it's a different kind of feel. And they've also been able to get these young, enthusiastic people to sell technology products, which is the way to do it.
Yeah,
John, I have been a bit. We've been hesitant to recommend JB in the past because the valuation, partly because of valuation, but there are a few weaknesses in that business model that I wanted to highlight as well. The largest weakness, the one I've always worried about, is the lack of distribution centers. So, we talked about the cost of doing business for JB being very low. Part of that reason is because most of the stock is delivered and stored inside the actual retail store. This is not,
which is what gives you the feeling of being in a market. With all the signage that kind of matches that feel.
And
you think you're getting a bargain because it doesn't look as though it's that well organized, but it's also far cheaper for them to do it that way.
Yeah, well, that's right, because the suppliers then act as their own DCs, distribution centers, because they're supplying inventory and stock at every individual store level, and that saves them a lot of distribution costs. That model is actually fantastic if you want to minimize your costs completely, but it doesn't really work if you want to set up an online business. And that's one of the reasons historically JB's had a pretty poor online presence, because clicking on the online on the website means someone physically going into the back room at a JB Hi-Fi store, picking an item up and putting it in a bag and sending it, which is extremely inefficient. But they're actually changing that now. They now have 3 distribution centers, and they're working on aligning the distribution centers with their online stores. I think they're turning into more of a conventional online retailer, which is probably a good thing once they've hit this size. So I think that solves one of the big problems I've had with this business for a while.
I'll just interrupt you there, and because I had a customer experience there. Where was it? Maybe 2 weeks ago, I was looking for a new fridge. They didn't have it in store, but I needed one of a particular size because the space in the kitchen is such that I can only get 1 or 2 times of fridge in there. And I went to the store in Maribyrnong in Melbourne, and they didn't have it on the floor, but I thought, I'm going to buy it regardless. A fridge is a fridge, as long as it fits. And he said, look, we don't have it. It's not in the warehouse. It's not on the shop floor. I said, look, whenever you can deliver it, mate. And he said, well, look, I'll give you a date of middle of May. And I said, okay, that's fine. It's like 3 weeks away. And it turned up the next day at 11 o'clock in the morning. I got a text and they were like bang on time. And I think they could only do that. They couldn't do that under their existing distribution model or the one that they used to use. They must have a warehouse somewhere where that order goes direct to the warehouse and comes to me the next day.
Exactly. Yeah. I mean, we talked about, for the supermarkets, we talked about retailers being really good at moving stuff as efficiently as possible. That has become JB Hi-Fi. It wasn't a few years ago, but the business has morphed into that. And I think as it cements its dominance, as it's impossible now to replicate that store network, as the sales are so vast that it can generate it can buy at the lowest cost and still make money on very low margins, it starts to look more and more like a supermarket, John. I think it has the dominance of a supermarket. It has the asset turnover and low margins of a supermarket. And it probably deserves, the 20 times multiple that supermarkets command rather than the 10, 12 times multiple that traditional specialty retailers tend to command.
There's just the upgrade cycles in electronics that favor a higher multiple, I would have thought, because, you buy your food every week, but, you go and buy a new telly every couple of years for $2,000 or $3,000 or something.
And if you're like us, you buy new clothes every 10 years.
That's right. Yeah. Graham, have you got any insider knowledge on JB Hi-Fi from your many visits to that store?
No, but I've always wondered how they've been able to compete against Amazon on online. But that's interesting that you say they match without question, have kind of turned that into a customer service strategy. Flip it, instead of being fearful of, oh my gosh, this customer is looking online, actually embrace it and kind of prove to the customer you can do better. So maybe that just ends up I still wonder how they can do it more efficiently than someone like Amazon. But in terms of moving stock cheaply, but maybe the first time you get that experience of them beating the price online, that just locks you in for the next 5 visits and you don't double check online. I'm not sure.
I also like the idea of having a local store when you're buying electronic stuff.
Yeah.
Because often, not say often, but it regularly doesn't work in the way that you expect. And I just hate sending stuff back to retailers online.
Yeah, I'm the same. I never refund stuff online, basically. And yeah, for those kind of things, I still prefer to go in and look at it.
Yeah.
There's one other big change, John, that JB has benefited from. And again, I wrote this in the article, but over the last 8 years, the way we have bought mobile phones has completely changed. If you remember, mobile phones used to be on subsidized contracts. You'd go to Telstra or Optus or Vodafone and you'd buy your phone from the carrier and you'd pay monthly commitments, interest-free, for the handset. So you effectively get a handset for $0, but you'd purchase the handset from the carrier. Those subsidies are dead. They're over. And handset retail has now moved to the electronics retailers. And JB has been the single biggest beneficiary. I reckon about 20% of their entire sales come from handsets. Those are pretty high margin, and it's an entirely new category that did not really exist for them in the days where we used to buy handsets from telcos. Now that one-off transition has resulted in lots and lots of sales growth. It's a one-off shift that isn't going to be replicated, but it is a recurring sort of purchase. So people tend to change their handsets every couple of years. So it adds to the supermarket-like feel where you get these recurring purchases happening.
Right. Okay, so that's JB Hi-Fi. It's not on the buy list yet. We would like to buy it below $70. It's over $100 now, and I think it's gone up. It's nearly doubled in the last couple of years. It's been an astonishing price increase. Would have been nice to get in earlier, but I don't think we really understood it in the way we understand it now.
Yeah, we probably
didn't really get it.
Yeah. The JB Hi-Fi has changed from being that conventional specialty retailer to being a much more dominant retailer, and I think we missed that change.
Yeah. Okay. Let's go on to our final retailer, which is we've covered before, but it's interesting because it is such a different kind of specialty retailer with kind of the opposite of JB Hi-Fi, but equally attractive. This is Gaurav again, but let's start with Graham. Graham, do you own Lovisa stock? And do you own any of their products?
No.
I was going to ask about the products before the stock, actually.
I'm not their primary client, I'm afraid. But I've always been a bit hesitant to own the stock, even though it's done very well over time. I just can't get my head around the competitive aspect of it. I see these other shops that seem like clones to an undiscerning customer on the outside, and I just wonder how they could do it any better. It seems always a low barrier to entry business to me. Yeah.
I think this is a classic kind of specialty retailer situation where you look at a stock, you look at Lovisa, and you could see it in the same way that I used to see Miller's Retail or the Reject Shop or something like that. Like these are kind of 10 a penny businesses that are easily replicable. You need to just sign up your leases and go and buy the products from China, and away you go. You've got a competitor. That should make for a really, really low margin business. The thing about Lovisa is that it's an incredibly high margin business, right, Gaurav? So what are they doing differently?
Yeah, it's actually, they make Apple-like margins. It's an 80% gross, 25% net margin. Unheard of.
For selling throwaway jewelry.
For selling And that is probably the key because I think one thing we've learned from the likes of Zara and to a lesser extent H&M and Uniqlo is that you can actually establish a lot of dominance in retail by following the fast fashion model. And that means controlling your production chain, your logistics chain really, really tightly and turning inventory over really, really quickly. We should probably unpack that a little. So Lovisa actually controls its entire production chain. They do the design work. They produce it themselves. Well, not that the CEO is saying they're making earrings, but they control they outsource the factory manufacture. But they don't purchase their goods from another party, and they design it all in house. And so you end up with these. You capture margin at every step along the way. You capture the producer margin, the distribution margin, and the retail margin. So you end up with 80% gross. And then as the store network grows, you collect all this data, and they own their own stores as well. So you end up collecting all this data about what fashion items are selling. This is a fashion business. So trends are really important, and trends depend on data. The more data you can collect on trends, the better your future product is going to be, because it can reflect the trends that you're seeing. And that's the reason why competitors can't really catch up to Lovisa. It's because they can't match the quick turnaround of product, because they don't have the back-end logistics chain. They don't have the design team, the manufacturing, or the very quick distribution. Remember, Lovisa supplies about 100 new items every 10 days in store. No one else can match that speed, and they can do that because every day they're capturing data about what items are selling, and they're feeding that back into the design and production process. And it's almost a feedback loop that helps the business not only grow, but protects it from competition. So if we think about the three of us trying to do a fashion business to compete with...
highly improbable. Like that. That's even less improbable than doing an AI business.
I don't know. I think there's a lot of artificial intelligence among the three of us, so we should do okay at that. Imagine all the advantages. I mean, forget all about the traditional retail advantages of leases, property locations. If we could replicate that, we would still have to figure out what was on trend, and we wouldn't have the rich data that Lovisa with 1,000 stores has. We wouldn't have the distribution in place that allows us to put 100 items in the store in 10 days. It's actually a deceptively difficult
It's an iron ore business.
No, this one's not iron ore. They actually have a relatively high cost of doing business because they have to move stuff around a lot, and they're not quite as efficient as a JB or a supermarket. So it's a little bit different to that. But it's the integration of all aspects of retailing, and then the capturing of the data, and then the feeding of that data back to the production process. So it is a lot harder to compete with than it appears, and you can see that from its business has been around for more than 10 years, and it still makes 80% margins and 25% net margins, and no one's been able to crack that.
Amazing.
To crack that competitive advantage yet.
I'll tell you guys right now, I am looking at an image of a sigmoid curve. Do either of you know what that is?
I have no idea what you're talking about.
Really? Okay, Graham, you got any idea what a sigmoid curve is?
No, the name is ringing a bell, but I'm blanking.
Okay, well, it's kind of useful. It actually plots. It's a thing that was originally applied to technology industries, where they plotted the number of patent applications of a new technology, and then as the technology began to take hold, it became what they call a pacing technology, and then a key technology, and then a base technology. And you can think of all technologies in that way, especially mobile phones. So in the early 1990s, they were an emerging technology, and then there was the growth phase, and then there was maturity, and now there's saturation. So that's what the S-curve is. It's a curve that bends like an S and up and towards the right. But it's also the same kind of curve that you get for a growth company like Lovisa, where in retail, you want to be at the bottom of the S-curve where the model has been proved, and I think Lovisa has proven the model. They've rolled out stores, so they've proved that they can manage a rollout, but they still haven't yet covered the country or covered the planet in thousands of stores. So it's an important concept as an investor in a growth business, is to work out where they are on the S-curve. So Gaurav, where do you think Lovisa is on the S-curve? How much growth is ahead of it before it hits maturity?
Yeah, well, for an Australian business, 1,000 stores is remarkable. I don't think there's, short of a Subway or a McDonald's, there isn't anything that has 1,000 stores. But remember, this is a global business. The Australian store footprint is 200 odd stores, and I think that's largely saturated now. We're not expecting store openings in Australia, but they are rolling the concept out internationally, and there is still plenty of countries that have no Lovisa stores, and even more countries that have not enough Lovisa stores. And then you've got same store sales growth on top of that. So I think we're still probably quite early on. And the amazing, I think the reason why sometimes there's so much skepticism about Lovisa is that we've never seen an international rollout. We're trained in Australia to think a company going overseas is a disaster waiting to happen. And we've never seen a successful. That's true. To be fair, that's probably the right instinct.
Yeah.
But this is working. It's working before our very eyes, and there's still, I think, too much skepticism about the success of this rollout.
Yeah, we bought this in the depths of the pandemic in I think it was March 2020 for under $5. It's now just under $25.
And it's about 50% off its highs as well.
And it's down from what it got close
37?
to 37 bucks. So it's a long way down. But yeah, I think we'd be interested in buying more of this stock, even though Graham is not a fan and and is quite suspicious of it. Graham, did you find Gaurav's argument persuasive? Is this something you would like to own?
It's just always one. It is a persuasive argument, and I can see the merits to it, but it's just one of those things that I think in the back of my mind, I see the two stores. Maybe it's because I am not a customer and I don't really get it. I look at the two stores next to each other and I think they're identical. Yeah. If one's cheaper than the other, I'm just going to go to that one. So yeah, I don't think I get it. And it might be one of those businesses that I just never really understand. But I think the fact that it's done so well over such a long period and really earns surprising margins probably just tells me that I don't get it.
Yeah. I think that's fine. I think that's fine. Like as an investors, we should only be investing in things that we get, that we understand.
Exactly.
And it's fine if you don't get this, Graham, and that's a perfectly fine and justifiable point of view. I would say that I feel as though I get it, even though I've never bought anything in there. Maybe I'm just telling myself that and I'll be proved wrong down the track. But it's just rare to see a retailer like this expand in the way it has with such a long growth runway. So I don't think we've seen anything like this in retail for quite some time, especially in Australia.
Definitely not in Australia. Yeah, definitely
not in Australia. This is a really, really unique kind of business, and it doesn't look like it, but I think it is. So both of you can be right. Like you can be persuaded that this is a unique business with global potential, and they seem to be taking advantage of that. Doesn't mean it's going to work out. And you can look at it and go, you know what, I just don't get this. I'm going to walk away from it.
And that's really
both of those
important
positions
instinct.
Are equally justifiable.
Yeah, that instinct of trying to wrap your head around something, it just doesn't gel with you. That's really important to listen to that, because you have to
don't want to force it.
Know yourself. I mean, my example of that, Graham, is ResMed, which I've never bought. I've never been comfortable with because I think it's such a lousy solution to the problem it's trying to solve. No one wants that solution, and yet it's a highly profitable, well-managed company that I've completely missed out on, but I've never been comfortable enough to buy it. And I think that your Lovisa is my ResMed.
Are you saying Croops doesn't find you with a CPAP machine on your face very, very sexy before she goes to bed at night?
Who wouldn't, John? The more of my face you can cover up, the better.
And on that bombshell, I think we'll end it there. Graham, thanks a lot for your time, and Gaurav too. We'll be back in 2 weeks. In the meantime, if you'd like to learn more about JB Hi-Fi or Lovisa or any of the two supermarkets we've discussed today, visit intelligentinvestor.com.au for a free trial.